Welcome to Season 3 of Primary Source China Investment. At the outset here, we wanted to highlight the importance of objectivity. Social media is full of strong opinions vis-a-vis China. Unfortunately, these strong opinions are the ones that attract the most eyeballs. This is why China government officials on Twitter or short sellers on CNBC get the most attention. Follow the money is always wise advice. And for Peng Guo and I, and to quote Carl Spackler, there'll be no money. So indeed, hit the subscribe button and we look forward to your continued participation. So we're here with show A3. And what we wanted to talk about was, are foreign investors selling China? The past week, the news came fast with emojis and exclamation points and a lot of big font headlines, record outflows. And that's absolutely true. But as we've mentioned in the past, we have a billion versus trillion problem. Outflows are in the billions from the equity and fixed income market, where the market cap for the China onshore equity and fixed income market is 25 trillion US dollar equivalent. So for a bit of perspective, here's the fund flows since 2013. As you can see, there's been 8 trillion of equity and fixed income from foreigners into China. So if we have a 30 billion US dollar outflow, so remember, 8 trillion is more than a trillion US dollars. So if we have a 30 billion outflow, which is what was recorded last month or in the last month and a half, that's about a 3% sell-off. Well, that's probably in line with what's been happening in the marketplace and also on the headline news. So let's look at a couple of those things that are happening. A, increasing rates globally. All other things being equal, this makes China less attractive. A year ago, the China 10-year was at 3.2 and the US was at 165. Now, China's at 2.8 and the US is at 245. Rates are rising in the US and the Fed is going to move. Investors are moving money in anticipation of this. So if you look at an investor allocating, they say, oh, I can get the China 10-year last year at 3.2 and the US at 165. But now those things have moved in different directions. China's come in, US has blown out. So if I'm allocating new money, I'm going to be selling China, buying US governments. B, Russian sanctions. The speed, organization, and scale that sanctions were implemented spooked investors. Foreigners pulled out of China and reallocated to other Asian and emerging markets like Korea and Taiwan. This is normal. C, lockdowns. Zero COVID. Well, COVID in general is a drag on growth, and the announcement that large cities on the mainland are shutting down is absolutely bearish. So I will say that these 3 items are the reasons why we saw a reallocation away from China. And again, it's a billion versus trillion dilemma. 30 billion out, but over the course of the last few years, $1 trillion in.
Generally speaking, we all know market is always right and follow the money. So no matter what happens, you will see the market. That is really tell you the truth. And the news, and that's a lot of the comments is really like the personal opinion. Why you get feel confused, just see the market. So that is the most accurate movement. But generally speaking, is I think a personal feel like the China fixed income market have much less volatilities compared with US bond market. Generally, I think we not just need to see the return and the yield, but we also need to check the Sharpe ratio. So from investor perspective, let's see the Sharpe ratio is reasonable or not. And secondly, we all know the global is really connected each other, especially for the financial market. So that's any big things, no country can be outside. So everybody get affected, especially for the big negative war-related issues. So this have a lot of the unexpected impact on the market. I bet nobody prepare for that. No investment model calculated for that. And right now it happens. So everybody probably get a shock. in my understanding, like in China, we do see like the equity market get a lot of the sales, and also other China-related funds get dropped. And probably one potential reason I heard it is a lot of the emerging market fund. They include the Russian-related stock and securities. So during the section period, all those funds get frozen. The investors really need redemptions. So investors are pretty simple. As long as the fund gets dropped, they want to redeem the shares. So that triggered a big problem for those funds. And the China market has the best liquidity during the crisis. So I think that's a huge advantage. Nobody paid too much attention to that because the market is big enough and deep enough, especially for some small cap companies and the smaller bond. You probably can get enough liquidities to get out of it. So in order to meet the customer redemption requirement, they have to sell the fund and sell a lot of the China related that you will see the Hong Kong market and the Asia market all get affected. So get a significant drop. After that, I think people still see the big news. They are all waiting for like the U.S. and China delisted companies negotiation and Fed how they want to at the 50 points in the next month. Those kind of big things. So I think really like the market is driven by the big news.
Yeah, this is part of the uncertainty, right? So we're going to get to that the listing in the U.S. But I wanted to circle back to the point you just made. When there's uncertainty and you need to raise cash, you're saying that China markets are very liquid, so people will just say, hey, I have to liquidate something. I can liquidate China because it's deep, liquid, fast-moving, high volume.
Yeah, that's true. Yeah.
Okay. Actually, that's a very good point. That I will add that to D. So A is increasing rates globally. B, Russian sanctions. C, lockdowns. D is probably liquidity. So China had a sell-off. People pulling money out of China because you can pull money out of China. There's still liquidity there. So pull money out of China, reallocate somewhere else, or just hold cash. That's absolutely the fourth reason I will put there.
Yeah, another very important thing is China investors probably get used to such high volatility. It's compared with U.S. investors. Like the real estate market, we talked about a couple of weeks ago. So like the very bearish for the real estate market. But unfortunately, during this crisis period, real estate market is the number one to get a bounce back. So that's a really lead the entire China Asia securities bounce back a little bit and also keep the market get stable. It's pretty much good signals for the economy. So those kind of things is hard to capture unless it's already happened or already bounced back.
There is the other side of this equation, right? There's the global economy, but there's also the local economy, and that's the macro side in China, which is what can the PBOC and other regulators do? And they are doing some stuff, right? So there's a lot of people talking about stimulus. Li Keqiang hinted that achieving 5.5 GDP growth would be arduous, was his word, and talked about tax cuts of more than 2.5 trillion renminbi. Two, weaken the renminbi to make exports more attractive. That's actually going to be a hard trick because raw material prices are global and those prices are going up. And then three is the point that you mentioned, which is ease foreign investors' minds. I mean, no other elegant way to put that, but it was reported late Friday that Chinese regulators are working to give U.S. regulators full access to auditing reports on the majority of the 200 plus companies listed in the U.S. as soon as mid-year. This is a big headline. It looks like a concession. It's not really a concession. It's about dialogue, and those kind of things look good. Get those 200 companies to comply with the audit regulations that have been in place and that 50 other countries have signed off on. But I suspect that these companies are going to find their way back to the mainland. That's just, my opinion. That looks like the trend, if I'm reading the trend correctly.
That's right. I think investment in China probably need different strategy and a different way to do it, rather than just the long only to do that. Like the bottom probably need to borrow some of the distressed debt or distressed bond, some equities to figure out. Because if two countries reach a good agreement, those two China-related sectors probably can bounce back. You can see that you can drop it like 40% a day, you can bounce back 40% a day.
And
That's so ridiculous.
And some of these are great companies. Pension's not going anywhere. This is a great company. It has massive earnings. It has good growth, right? This is a real company. It's a well-run
probably
company.
Big money is that is how investor make the big money period, rather than get a regular 5 or 10%.
Yeah. Well, I do say trading this market is very, very, very difficult. Trading China market, buy and hold simple beta is also very difficult. That's why we always talk about asset allocation. I mean, we just keep repeating ourselves, Peng Guo. Eventually they're going to listen to us, I promise. But, this asset allocation, the trend following, all of these things are, we talk about them for a reason, because the individual stock volatility, even the market volatility, is far too high for most investors because they're just not compensated for it.
Exactly. Yeah, that's totally right.
Yeah, well, we keep saying it, but hopefully they'll come listen. With that, we're going to leave it here for show A3. Welcome to the new season. Hope to have a lot of great content coming your way soon.
Thank you. See you next week.